Hello everyone, welcome to the May 21st Thursday edition of Market Opening Bell, your 10-minute guide to the stock market. US 30-year Treasury yields hit the 19-year high, causing the three major US stock indexes to fall on Tuesday. The Hang Seng Index opened 88 points lower on Wednesday and saw its losses widen throughout the day, closing at 25,651 points, down 146 points or 0.6%. Total market turnover reached 262 billion Hong Kong dollars. The Hang Seng Tech Index bucked the trend and rose to 4,873 points, up 16 points or 0.3%. The H-share index closed at 8,605 points, down 34 points or 0.4%. Southbound funds net bought 5.708 billion Hong Kong dollar worth of Hong Kong stocks. Among them, net purchases included SMIC at $2.166 billion, China Mobile at $1.564 billion, Hua Hong Semiconductor at $798 million, Tencent at $409 million, SMIC at $403 million, Yangtze Optical Fiber and Cable at $216 million, and Montage Technology at $204 million. Net sales included Giga Device Semiconductor at $470 million and Alibaba at $168 million. According to statistics, Southbound funds have net bought Tencent for 5 consecutive days, totaling $1.84 billion. Montage Technology for 5 consecutive days, totaling $1.112 billion. SMIC for 4 consecutive days, totaling $3.464 billion, and SMIC for 3 consecutive days, totaling $1.329 billion. Technically, the Hang Seng Index is trading in a narrow range around its 50-day moving average at 25,781 points. The key support level sits at 25,500 points, while the immediate resistance is at 25,950 points. The Shanghai Composite Index fell 7 points or 0.2% to close at 4,162 points. The Shenzhen Component Index closed flat at 15,569 points. The Chinex Index rose 13 points or 0.3% to 3,921 points. Combined turnover in Shanghai and Shenzhen reached 2.95 trillion yuan. The Star 50 index surged 3.2% to a new all-time high. The renminbi central parity rate against the US dollar stood at 6.8397, down 22 pips from the previous day. The People's Bank of China kept the loan prime rate LPR unchanged for the 12 consecutive months, with the 1-year LPR at 3% and the 5-year LPR at 3.5%. The news that Yangtze Memory Technologies (YMTC) has started its A-share IPO process boosted market sentiment. SMIC surged 9.7% to $75.15, becoming the best performing blue chip stock of the day. Hua Hong Semiconductor rose even more sharply by 13.9%. YMTC, founded in July 2016 and headquartered in Wuhan, Hubei, is China's largest and a global leading designer and manufacturer of 3D NAND flash memory chips. As a vertically integrated IDM semiconductor company, its business covers the entire chain from chip design, wafer manufacturing, packaging, and testing to memory system solutions. YMTC officially launched its A-share IPO process in May 2026 with a market valuation exceeding 160 billion yuan. The company continues to expand production capacity in Wuhan, including building new wafer fabs. Its global NAND flash shipment market share is estimated to have reached around 13 to 15%. Before YMTC's rise, the high-end NAND flash market was long dominated by Samsung, SK Hynix, Micron, and other US, Japanese, and Korean giants, together with CXMT, which focuses on DRAM. YMTC has formed the two main pillars of China's domestic storage chip industry. Changxin Memory Technologies, CXMT, founded in May 2016 and headquartered in Hefei, Anhui is currently China's largest, most technologically advanced, and the only company achieving large-scale mass production of DRAM. By capacity and shipment volume, CXMT ranks first in China and fourth globally. It operates three 12-inch wafer fabs in Hefei and Beijing, with total wafer input expected to reach 300,000 wafers per month in 2026. The company updated its prospectus in May 2026 and is accelerating its IPO on the Shanghai Star Market, planning to raise 29.5 billion yuan. Hong Kong-listed gold stocks continued their downward trend, driven by inflation concerns and rising U.S. Treasury yields. Spot gold briefly fell below $4,460 per ounce in early Asian trading. With rising yields and a strong dollar, gold prices may face further pressure in the short term. However, the core logic supporting gold's long-term trend remains intact, and the market views this as a healthy correction. Hong Kong-listed photovoltaic stocks kept falling due to the combined pressure of fading policy incentives, deep fundamental losses, and slow capacity reduction. Since the beginning of 2026, the photovoltaic industry has faced major policy changes. From April 1st, the export VAT rebate for photovoltaic products was cut directly from 9% to 0%. The export rebate used to be a key profit source for PV companies, while industry self-discipline had been crucial for stabilizing prices. With both supports removed, the industry has officially entered a naked swimming era, where market supply and demand will determine prices. In addition, the first quarter of 2026, 22 major companies in the PV supply chain reported combined revenue of 95.856 billion yuan, down 11.67% year-on-year, and aggregate net profit attributable to parent companies showed a loss of 10.554 billion yuan, with all five major module leaders suffering losses. GDS Holdings announced that its first quarter net profit attributable to shareholders reached 2.649 billion yuan, a 247% increase from the same period last year. The sharp rise was mainly due to one-off gains from selling part of its stake in Day One. Excluding these one-off items, core net income grew 7.9% year-on-year to 2.938 billion yuan. Falling short of high growth expectations. As a result, its U.S. stock price plunged more than 16% after the results. The company recorded a record high 200 megawatt of new orders in the first quarter, reflecting explosive growth in AI-driven infrastructure demand. Management said it has expanded its land reserve to nearly 4 gigawatts to meet massive AI needs and plans to invest 30 to 50 billion yuan in capital expenditure over the next 3 years. Such large-scale investment will increase debt levels. Management expects the net debt to EBITDA ratio to rise to 5 to 6 times. While they believe this leverage is acceptable and controllable, it has raised concerns among some risk-averse investors. ZTO Express released its first quarter results for the period ended March, showing a high-quality development trend of strong revenue growth, steady profit improvement, and expanding market share. The standout highlight was that parcel volume growth significantly outperformed the industry average, while core per-parcel pricing rebounded thanks to an improved express delivery market environment in China. First quarter revenue reached 13.282 billion yuan, up 22% year-on-year, and beating market expectations of 12.8 billion yuan. Gross profit rose 20.3% to 3.235 billion yuan, with a gross margin of 24.4%, slightly down 0.3 percentage points from 24.7% a year earlier, mainly due to a higher proportion of lower margin reverse logistics business. Net profit was 2.118 billion yuan, up 6.3%. Basic earnings per share were 2.73 yuan. Adjusted net profit was 2.377 billion yuan, up 5.2%. First quarter parcel volume reached 9.668 billion pieces, up 13.2% year-on-year, 7.4 percentage points above the industry average. As of the end of March, the company had over 31,000 pickup delivery outlets, about 6,000 direct network partners, more than 10,000 self-owned line haul vehicles, around 3,800 inter-sorting center line haul routes, and 93 sorting centers, 88 operated by the company and 5 by network partners. Per-parcel pricing for its core express business rose 8.2% year-on-year, and per-parcel transportation plus sorting costs improved by 6 fun, thanks to economies of scale. Selling expenses as a percentage of revenue fell from 4.7% to about 4.5%. Operating cash flow was 2.8 billion yuan, with capital expenditure of 1.8 billion yuan. Based on current market and operational conditions, the company reaffirmed its 2026 parcel volume guidance of 10 to 13% year-on-year growth, or between 42.37 billion and 43.52 billion pieces. China State Post Bureau reported that total postal delivery volume in the first 4 months reached 70.16 billion pieces, up 4.1% year-on-year, of which express delivery volume was 64.57 billion pieces, up 5.1%. Thanks to holiday-driven online consumption and after years of vicious price wars, the express industry is seeing rationalized pricing as regulators push for anti-inflation policies in high-quality development, leading to broader profit recovery across the sector. Intersport saw its associate Amer Sports deliver first-quarter results that beat expectations and raised full-year guidance. Strong growth in Greater China of 44.5% provided positive support for ANTA. Amer Sports' total first-quarter revenue reached $1.945 billion, up 32% year-on-year, exceeding market expectations of $1.83 billion. Adjusted net profit surged 47% to $218 million. Adjusted gross margin expanded 200 basis points to 60%, and adjusted operating margin rose 160 basis points to 17.4%, highlighting strong pricing power and scale effects. Full-year revenue growth guidance was raised from 16 to 18% to 20 to 22%, and adjusted earning per share guidance was lifted from 1.1 to $1.15 to 1.18 to $1.23. US President Trump stated that negotiations with Iran have entered the final stage. Combined with falling US Treasury yields, US stocks rebounded on Wednesday as the market digested the Federal Reserve's latest monetary policy meeting minutes. The fear gauge VIX index dropped 0.62 points or 3.4% to 17.44. The Nasdaq rose 1.5% to 26,270 points. The S&P 500 gained 1.1% to 7,433 points, both ending a 3-day losing streak, while the Dow Jones climbed 1.3% to 50,009 points. The Nasdaq China Golden Dragon Index, which checks Chinese stock, fell 30 points or 0.4% to close at 6,760 points. Most sectors closed higher, led by consumer discretionary stocks, while the energy sector recorded the largest decline. Thanks to falling oil prices, airline and cruise stocks performed strongly. United Airlines surged 10%, making it the top gainer in the S&P 500. Delta Airlines rose 9.4%, and both Carnival and Norwegian Cruise Line climbed more than 8%. Hasbro reported an operating loss in its consumer products division for the first quarter, although overall group results beat expectations. Its share price still fell 8.8%, becoming the worst performer in the S&P 500. Nvidia announced first quarter revenue that exceeded market expectations, driven by strong performance in its data center business. Amid robust AI demand, revenue jumped 85% year-on-year to $81.62 billion, beating estimates of $78.91 billion. Data center revenue soared 92% to a record $75.25 billion, surpassing expectations of $73.13 billion. Adjusted earnings per share rose from $0.78 a year ago to $1.87. The company announced a quarterly dividend increase from $0.01 to $0.25 per share, payable on June 26 to shareholders of record on June 4th. The board also approved an additional $80 billion share repurchase authorization. CEO Jensen Huang said that construction of AI factories is accelerating at an extremely fast pace, and agentic AI has begun to deliver real value and is rapidly expanding across enterprises and industries, with Nvidia at the center of this transformation. The company expects second quarter revenue of $91 billion plus or minus 2%, well above the market consensus of $87.29 billion. Nvidia's shares fell 0.9% in after-hours trading. The stock is still up nearly 20% year-to-date as of Wednesday's close. Lowe's reported first quarter results that beat expectations and maintained its full-year guidance unchanged. Adjusted earnings per share came in at $3.03, up 3.8% year-on-year and above the expected $2.97. Sales rose from $20.93 billion to $23.08 billion, beating market forecasts of $22.98 billion. Comparable sales increased 0.6%, supported by roughly 16% online sales growth and demand for appliances and home services, though this was slightly below the expected 0.7%. Lowe's kept its fiscal 2026 guidance intact, forecasting adjusted EPS between $12.25 and $12.75, sales of $92 billion to $94 billion, and comparable sales flat to up 2%. The market expects full-year non-GAAP earnings per share of $12.58 and sales of $93.25 billion, with same-store sales growth of 1.3%. Target raised its full-year sales growth forecast after delivering better than expected first quarter results. The company now expects fiscal 2026 sales to rise 4% year-on-year, higher than the previous guidance of 2%. It also indicated that adjusted earnings would land at the higher end of the previously announced $7.5 to $8.5 range. The market expects non-GAAP earnings per share of $8.12 for the 3 months ended May 2nd. Adjusted earnings per share rose 32% year-on-year to $1.71, beating expectations of $1.47. Sales increased from $23.85 billion to $25.44 billion, exceeding forecasts of $24.66 billion. Comparable sales grew 5.6%, well above the expected 2.4%. with comparable store sales up 4.7% and digital sales up 8.9%. Transaction volume rose 4.4% year-on-year, reversing a 2.4% decline in the same period of 2025. The stock fell 3.9%, making it one of the larger decliners in the index. The Federal Reserve's April meeting minutes showed that participants generally believed high inflation combined with uncertainty from the Iran conflict could require interest rates to remain higher for longer than previously expected. Many officials indicated that if the Middle East conflict persists and keeps inflation above the 2% target rate, hikes might need to be considered. U.S. Treasury yields fell sharply in the afternoon session, with the 10-year yield dropping 9.6 basis points to 4.58% and the 2-year yield declining 7.4 basis points to 4.05%. Our stock pick today is 51World, stock code 6651. 51World is deeply focused on the intersection of 3D graphics, simulation, and artificial intelligence. The group has established 3 core technological pillars for building physical AI: World Spatial Model, Simulation, Training Platform, and Synthetic Data Field, with the commercialization of high-level intelligent driving technology. The group's 51SIM business has experienced rapid growth. According to a Sullivan report, in 2025, 51SIM held the leading 53.5% market share in China's end-to-end high-level intelligent driving simulation and data platform market. By the end of 2025, 51SIM's cooperating customers covered 55% of the global 20 passenger vehicle OEMs and 60% of those in China. It also achieved 100% cooperation coverage with China's 6 major national-level authoritative testing and evaluation institutions, establishing itself as the data infrastructure provider for autonomous driving system, validation, and evaluation. The group's 51AES digital twin platform maintained steady growth, continuing to deliver benchmark projects in small cities, water conservancy, high-end manufacturing, and other sectors. It also launched 51Gene Geological Energy Information Model to expand into the underground engineering safety monitoring market. In 2025, 51AES integrated with Canova and scaled up the use of AI plus PCG generation tools in its delivery process, significantly reducing reliance on manual modeling and effectively improving delivery efficiency per person. 51Earth Digital Earth Platform, as the carrier of the group's long-term vision, has launched 2 major AI platforms, Canova and Data. The former, integrated with 51AES, provides spatial management applications with natural language interaction, while the latter empowers 51SIM by offering dedicated training environments and data support for embodied intelligent robots in real-world applications. In 2026, with the advancement of high-level intelligent driving commercialization and the implementation of related regulatory requirements, 51SIM will collaborate with industry partners to launch the physical AI factory model. Unlike traditional testing software licensing, this model integrates computing power, software, and data, allowing customers to pay based on actual usage of computation and data. This approach will not only reduce clients' costs of building their own testing centers, but also provide the group with stable and recurring service revenue. At the same time, 51SIM's applications are gradually expanding from autonomous driving to broader physical AI fields such as embodied intelligence and low-altitude economy aircraft, further enlarging the group's addressable market and business scale. In response to various industries' demand for spatial computing, 51AES will promote full-stack localized solutions in 2026, deepen the application of spatial intelligence technologies, and expand into overseas markets. Suggested entry price at $73, target price at $81, stop loss at $69. I do not hold the above stock.